The Labor government promised they wouldn't touch negative gearing. But if the rumours around tomorrow night's budget announcement are true, that promise may be about to change. And if these changes are introduced, they could have major implications for the Australian property market. Now, before we get into this, I need to make something very clear. At the time of recording this video, these are still proposed and rumoured changes and are yet to be formally confirmed in the May 12 budget announcement. But based on the reporting and commentary coming out over the last few weeks, these policies appear to be increasingly likely. And whether you think these changes are good or bad, I'll let you decide that for yourself by the end of the video. Because today I want to focus less on policies and more on behaviour, because property markets are driven by behaviour. And when governments change incentives, they change behaviour. And when behaviour changes, markets change. So here are the three major proposed policy changes and the likely impacts they could have on the Australian property market. The first proposed change is around negative gearing. Now, according to multiple sources and rumours, negative gearing benefits may be removed for future purposes of existing properties, meaning that if you already own an investment property, you may retain your current benefits under grandfathering provisions. But going forward, new investors purchasing existing property may no longer be able to claim negative gearing losses against their income. Instead, negative gearing benefits may only apply to newly built properties. Now, this is important, because when investors lose a tax benefit, they don't just absorb the cost and move on. They change behavior. And one of the most likely behavior shifts is that investors purchasing existing properties will attempt to compensate for the loss of those tax deductions through higher rents. Because if holding costs increase, investors will naturally try to recover those costs somewhere else. And ultimately, that cost gets pushed onto tenants. Now, of course, some people will argue that investors shouldn't rely on tax benefits in the first place. And there's definitely some truth to that. But regardless of your opinion on negative gearing, removing a financial incentive changes the economics of holding property. And when you change economics, you change decision making. Now, the second major proposed change is around capital gains tax. Specifically, the rumours suggest that the government may move away from the current 50% capital gains tax discount and return to the old indexation method. Now, historically, before 1999, Australia used an indexation system for capital gains. This adjusted the purchase price of an asset for inflation, rather than simply relying on discounting the gain by 50%. Then, in 1999, the Howard government introduced the current 50% discount for assets held longer than 12 months. And that fundamentally changed investor behavior, because suddenly there was a strong incentive to hold assets longer term and then realize gains under a concessional tax structure. Now, if that discount disappears, investor behavior will change again, because selling property becomes more expensive from a tax perspective. And when selling becomes less attractive, people hold on to assets for longer. Now, think about what that means in practical terms. If investors become less likely to sell, that reduces the supply of established property entering the market. And we've all seen what happens when supply decreases, while population growth and demand continue. That creates upward pressure on prices. So ironically, a policy designed to make housing more affordable could potentially reduce the amount of existing housing available for purchase. Again, this comes back to behavior. Governments don't just change tax policy, they change incentives. And incentives shape the market. Now, the third proposed policy change links back to the first, and I've already touched on this one a little bit already. That is the idea that negative gearing benefits may only apply to newly built property. Now, on the surface, this sounds logical, because the argument is that if investors are pushed towards new construction, that will help increase housing supply. And in theory, that makes sense. But in reality, there are some serious structural problems with that idea, because Australia already has a shortage of tradespeople. Construction costs have increased significantly. Building timelines have blown out. Red tape is rife in the industry, and infrastructure in many growth corridors is already under pressure. So simply increasing demand for newly built property doesn't automatically increase supply. In fact, what often happens is the opposite. More demand enters the construction market, while supply remains constrained, and that pushes prices higher. Now, another likely behavior outcome from this policy is that investors may start flooding into off-the-plan apartments and house and land packages, simply because that's where the tax incentives still exist. But again, that doesn't necessarily improve the supply of quality housing where people actually want to live, because not all supply is equal. And this is something that the broader property conversation often misses. Building more properties doesn't automatically solve affordability issues. If they're being built in locations where infrastructure, employment, transport, and demand fundamentals aren't already aligned. Now, stepping back from all three proposed changes, there's a much bigger point here. Whether you support these policies or oppose them, they will absolutely change investor behavior. And markets are ultimately driven by behavior. If investors are incentivized to hold property longer, supply changes. If investors lose tax benefit, rental pricing changes. If incentives are redirected towards new construction, demand patterns shift, building quality goes down, and governments know this, which is why governments are often extremely careful and tight-lipped around tax policy changes before budgets are announced. Because the moment people believe a change is coming, behavior changes immediately. People rush to exchange contracts, people delay sales, people reposition portfolios, markets move before legislation is even passed. And that's exactly why these rumors matter. Because even before policy becomes law, expectations alone can influence decision making. Now, personally, I think we need to be careful simplifying property markets down to good or bad policies, because every policy has second order effects, and often those effects are very different to the original intention. So whether these changes ultimately improve affordability, increase rents, reduce supply, or reshape investor demand, we'll have to wait and see. But one thing is certain: if these policies are introduced tomorrow night, they will change behavior. And when behavior changes, the property market changes with it. Now, I'd love to hear your thoughts in the comments below. Do you think these proposed changes will improve housing affordability? Or do you think they'll create more pressure on rents and supply over the longer term? And if you want to help understanding how these potential changes may impact your own investment strategy, you can book in an initial strategy consultation using the link below. Otherwise, if you found this video valuable, make sure you like and subscribe. And I'll see you in the next video.